Hello, dividend investors in Singapore, and welcome back to the Dividend Uncle channel. In today's video, we're going to talk about the 6 things I regret not doing sooner on my journey as a dividend investor right here in Singapore. These lessons have been learned through my own experiences, often with specific stocks and REITs, and I hope that by sharing them, you can avoid making the same mistakes. If you're new here, don't forget to subscribe and hit that notification bell so you never miss our weekly dividend investing insights. Now, let's dive right in. First and foremost, I wish I had started investing in dividend stocks here in Singapore sooner. Time in the market is a powerful ally, especially in our lion city. For instance, if I had invested in Sembcorp Industries 5 years ago, I'd be sitting on a total return of over 70%. This is despite the stumble in 2020 with the COVID crisis. The earlier you start, the more you can benefit from the magic of compounding, and real examples like Sembcorp Industries show us that. Don't wait for the perfect moment to begin, just start with what you have. Time will be your greatest asset. Regret number 2 is not diversifying my dividend portfolio enough, something that's crucial in Singapore's unique market. In the beginning, I focused too heavily on a few local dividend stocks I was familiar with. This left me vulnerable to market fluctuations. Diversification is key for risk management, especially in a small market like ours. Take the example of the Straits Times Index, or the STI, our benchmark. It's a well-diversified index that has outperformed many individual stocks in the long run. Spread your investments across different sectors and industries to reduce risk and ensure a steady stream of income. Now with STI ETF we can easily achieve such diversification, with one unit of the ETF representing an investment in 30 top shares in Singapore, all with an attractive dividend yield of 4.0%. Mistake number 3 is chasing high-yield dividend stocks without considering their sustainability, which can be tempting here in Singapore. High yields often come with higher risk. Take the example of First REIT, which once offered eye-popping potential yields before its financial troubles. The trust eventually faced severe difficulties, and investors who chased those high yields suffered significant losses, with share prices falling more than 80% over 5 years. It's better to invest in companies like Credit Bureau Asia, which may have lower yields of about 3.5%, but offer stability and reliability over the long term. Another regret I have is not paying enough attention to dividend growth, especially in Singapore's vibrant market. Companies that consistently increase their dividends year after year are like hidden gems. One such gem is Realty Income Corporation, a US-based REIT. It has a track record of raising dividends for over 5 decades. Imagine the wealth you could accumulate if you had focused on such dividend growth stocks here in Singapore. Find local companies with a similar track record, like Parkway Life REIT, which has consistently raised dividends since its listing. Look at how its distribution per unit or DPU has increased by 127.5% since IPO in 2007. Regret number 5 is not taking full advantage of dividend reinvestment programs or DRIPs, a strategy that works wonders in Singapore. Reinvesting dividends can supercharge your returns here in our lion city. Companies like Capital and Ascendus Real Estate Investment Trust offer DRIP options. By automatically using your dividends to buy more shares, you can accelerate your wealth-building process. Last but not least, my 6th regret is letting emotions drive my investment decisions in Singapore's dynamic market. Our stock market can be a roller coaster, and it's easy to get caught up in the fear and greed cycles. For example, during the market crash in 2020, some investors panicked and sold their shares in Keppel Corporation at a low price, only to see it bounce back strongly. This is despite Keppel Corp distributing Sembcorp Marine, currently known as Seatrium, shares to investors for free in early 2023. It's essential to stick to a well-thought-out investment strategy and not let emotions cloud your judgment, especially when navigating the Singaporean Stock Exchange. These are the 6 things I regret not doing sooner as a dividend investor right here in Singapore. Whether you're just starting your journey or have been on it for a while, I hope these insights help you make better investment decisions in our lion city. Remember, investing is a marathon, not a sprint. Take your time, stay disciplined, and focus on your long-term financial goals. If you found this video helpful, please give it a thumbs up and share it with your fellow Singaporean dividend investors. And as always, Stay tuned for more dividend insights here on the Dividend Uncle channel. Thanks for watching.